Welcome to the deep dive. If you're looking for ways to build up some consistent passive income, well, dividend stocks have probably popped up on your radar, right? They're sort of a classic way to get your money working for you, generating that steady cash flow. Today, we're going to zoom in on one company that's, well, it's really turned some heads. Energy Transfer, or ET. They've got this distribution yield. It's over 7%. Pretty impressive. But, high yields often mean there's a bit more to understand. So our mission here in this deep dive is to unpack what makes Energy Transfer so appealing, especially its structure, what that means for you, the investor, and what complexities might be part of the deal.
Right. So Energy Transfer, at its heart, it's a midstream operator. Think of them like the crucial infrastructure, the pipelines for the energy sector. They're moving, storing, processing oil, gas, natural gas liquids, all of it. And the key thing for stability, their revenue is mostly locked in, long-term contracts, often fee-based. So it's less about the crazy swings in oil prices. It's more of the volume going through their system, which is generally pretty steady.
Okay, let's unpack that, because that stable income, that sounds really good for investors. But you mentioned a unique structure, and one of the big things with Energy Transfer is it's a master limited partnership, an MLP. That term, MLP, it can sound a bit technical maybe.
Yeah.
What exactly is an MLP, and what's the magic behind it that lets them offer that kind of yield?
Yeah, it's actually fascinating. MLPs have this special tax status. Yep. So unlike your typical C Corp, they don't pay corporate income tax at all. So imagine that money, instead of going to the government from the company, it passes directly through to the investors, to you, the unit holders.
Ah, okay. So it's a pass-through entity.
Exactly. And that pass-through structure, that's the raw power behind that really eye-popping yield over 7%. It just means MLPs like Energy Transfer can return way more cash to their investors. And actually, they've said they want to grow those distributions too, aiming for something like 3 to 5% growth each year.
Wow. Okay. That tax efficiency is definitely a huge draw, a major advantage for income folks. So the structure's key. But ET isn't just its structure, right? It's also, sounds like, benefiting from some bigger trends. What's going on in the wider energy market that's helping them out? Are there headwinds too we should consider?
Well, yeah, they're really well positioned for a couple of big things happening right now. First, just the sheer amount of oil and gas being produced in the U.S., it's surged. And all that needs to get moved somewhere.
Right. More volume.
More volume. And second, the regulatory side in the U.S. seems to be, getting more supportive for building out energy infrastructure. You hear talk about increasing domestic energy production, achieving American energy dominance. That directly means more stuff flowing through networks like Energy Transfers. It feeds right into their business model.
Okay. So they're kind of in the right place at the right time, with the right assets.
And the scale is just enormous. Energy Transfer has one of the biggest, most diversified portfolios of this kind of infrastructure in the whole country. We're talking major pipelines for NGLs, for crude oil, for natural gas, plus huge storage facilities, export terminals, which are crucial now, processing plants, and they're spread across all the key basins geographically. This creates something people call a network effect.
A network effect? How does that work here?
Well, think about it. The more producers get connected to their system and the more end users rely on it, the more valuable that existing infrastructure becomes. Yeah. It's harder and harder for anyone else to replicate it.
That makes sense. It's like a web that just gets stronger and stickier the bigger it gets. Does that mean it's tough for competitors to break in?
Exactly. It builds a really significant barrier to entry. I mean, building something like this from scratch, it takes decades, billions of dollars. Yeah. Once you have that network established, the more connections you add, the more efficient and, frankly, indispensable you become.
Okay. So, stable income, tax advantages, market tailwinds, this network effect. It sounds pretty compelling. But here's where it gets really interesting for me. If you've followed energy investing for a bit, you might know Energy Transfer's past. It's been, let's say, eventful, especially around how they funded all this growth. Can you talk about that, their historical approach, and maybe more importantly, where are they now financially after some pretty big bets?
Yeah, no, you're absolutely right to bring that up. That's been a common criticism historically. Energy Transfer was known for being quite aggressive with growth, big acquisitions, very capital-intensive projects, and often funding them by taking on more debt or by issuing new units, which can dilute existing holders.
Right. Like, didn't they just do a big deal recently?
They did. There was the $3.25 billion deal for WTG Midstream Holdings. And before that, a $2.7 billion expansion on the Hugh Brinson pipeline. Now, these moves definitely expand their reach, their capacity, but yeah, in the past, deals like that definitely raised eyebrows about leverage and financial risk.
So has anything changed? Or is it still grow at all costs?
This is actually where the story takes a positive turn, I think. Over the last few years, management seems to have made a real strategic shift, a pivot. They've been using their excess cash flow quite diligently to pay down debt, to improve their balance sheet. Their key leverage ratio, net debt to EBITDA, it stands at 3.85 right now.
3.85. Is that good? What's the context there?
Well, yeah, for them, it's actually pretty good. Based on their roughly $60.6 billion in total debt and about $15.7 billion in EBITDA, that 3.85 is actually toward the lower end of where they've been over the past decade. And importantly, it's well within their own target range, which they state as 4.0 to 4.5 times.
Okay, so they're hitting their own targets, and it's lower than it has been. That sounds like progress.
It shows much more financial discipline, a stronger footing. And that's a big deal for investor confidence, you know?
That definitely is a significant shift from maybe the perception some people had, moving from that aggressive past to a more stable present. But, some investors just see any debt in a capital-heavy industry like this as a potential red flag. Even with the improvement, could that leverage still be a risk if things turn south, like in a big downturn?
That's a totally fair question. And you're right, 3.85 is much better for ET. But the energy sector is cyclical, no doubt about it. So could a really severe long downturn impact them? Theoretically, yes. Even fee-based contracts could face pressure if producers are in extreme distress.
Right.
However, their diversification is huge across different types of energy, different regions. Plus, those contracts are mostly long-term fixed fee. That gives them a pretty substantial buffer against just like daily price swings in oil or gas. They're way less exposed than a pure producer. So yeah, no company is totally bulletproof in a massive economic shock, but their current financial setup makes them, I'd say, quite resilient.
Okay, that makes sense. Resilience is key there. Which brings us back to the investor, to you listening. This raises a really important question. Given everything, the MLP structure, that nice yield, the improved finances, what are the critical things you need to consider, especially when tax time comes around? Because this isn't just like buying shares of, say, Apple, is it?
Not at all. Exactly.
Yeah.
That MLP structure, while it's great for avoiding corporate taxes, it definitely comes with unique tax treatment for you, the unit holder. And yeah, it can catch people by surprise.
Yeah.
Instead of the simple 1099 form you get for a regular stock dividend.
Which my broker just sends, yeah.
Right. With an MLP, you get something called a Schedule K1. And for a lot of people looking at a K1 for the first time, it can feel like navigating a maze. It's just more complicated.
More complicated how? Like, do I need an accountant?
Well, it often requires more detailed reporting on your tax return. It breaks down different types of income, deductions. It just takes more attention than glancing at a 1099.
Yeah.
Some people handle it themselves. Others definitely prefer professional help, especially at first.
Okay, so the K1 is one hurdle. Anything else?
Yes. And this one's important. MLPs can generate what's called unrelated business taxable income, UBTI. Now, here's the sort of subtle trap, especially if you're thinking about holding MLPs in a retirement account like an IRA or a 401k.
Oh, why is that? I thought those were tax sheltered.
They are, mostly. But there's a threshold for UBTI. If you earn more than just $1,000 in UBTI from all your MLP holdings within that IRA in a year, suddenly you might have to file an extra tax form, a Form 990T. And you might actually owe taxes on that income, even though it's inside your supposedly tax-deferred IRA.
Wait, let me get this straight. I put money in an IRA specifically to defer taxes. But if I buy an MLP in there and it generates over $1,000 of this UBTI stuff, I could still get a tax bill and have to file another form.
That's exactly right.
That feels like it totally defeats the purpose for a lot of people. Is there any good reason to hold an MLP in an IRA then?
You've nailed the key issue there. For most investors, especially if you value simplicity and really want that straightforward tax deferral from your IRA, holding MLPs in there usually isn't the best approach, precisely because of that UBTI threshold and the potential hassle.
Right.
The administrative burden, the risk of an unexpected tax bill, it often outweighs the benefits within that specific account type, which is why, for a stock like Energy Transfer, the general wisdom is it's much better suited for a regular taxable brokerage account. There, the K1 income just flows through to your normal tax return. No UBTI worries specific to retirement accounts.
Okay, that's a really crucial distinction. Taxable account is generally the way to go for these. So let's try and pull this all together for you, the listener. Energy Transfer. Looks like a pretty compelling story for passive income, right? You've got that
Mhm.
high yield, a stable business model, it's diversified, operates in a pretty good environment right now, and they've shored up their finances. But, and it's a significant but, it absolutely comes with those unique tax things.
Mm.
The K-1 form, the potential UBTI issue in retirement accounts, those administrative complexities.
Yeah, and connecting that back to your own investment journey, really understanding that extra layer of tax treatment is, well, it's critical. You have to know what you're getting into before investing in ET or any MLP. It really just boils down to weighing those potential rewards, that significant income stream against the complexities. The K-1 hassle, the account type considerations, is that trade-off worth it for you?
Right. It's a personal calculation. So maybe the thought to leave you with from this deep dive is this. Beyond just the numbers, the yield, the growth prospects, how much do you personally value simplicity when it comes to your taxes and your investments? And how might that influence whether something like an MLP with its unique structure fits into your overall strategy, something to definitely chew on?